Welcome to the Explainer. Today, we're going to tackle something that's at the core of all investing, that constant tug of war, that balancing act between risk and return.
Okay, so let's just get right to it. Everybody wants high returns with absolutely zero risk, right? I mean, who wouldn't? That's the dream.
Yeah, well, so does everyone. The thing is, investing just doesn't work like that. It's always a trade-off. It's a calculated dance between what you could gain and what you could, well, lose.
All right, so let's start breaking this down. First up, we've got to talk about the upside, the fun part, calculating the return. So the most basic way to look at this is something called return on investment, or ROI. It's really just a simple percentage. Think of it like a report card for your investment. It tells you how much you made or lost compared to what you originally put in.
Okay, let's put some numbers to this. So in this example, you buy some shares, you pay a little commission, you get some dividends, you add it all up, subtract the costs, and boom, you get a return of 23%. And, at first glance, 23%, that sounds pretty awesome, doesn't it?
But there's a catch, and it's a big one. That 23% number is kind of floating in space. It's missing a crucial piece of the puzzle, time. I mean, think about it. A 23% return in 1 year is very, very different from getting that same 23% over 5 years. So what that tells us is we need a better tool for the job. Just annualizing it isn't enough, because that doesn't really get the magic of compounding. And that's where something called CAGR, the compounded annual growth rate, comes in. It's so much better because it gives you this smoothened out average annual growth rate, taking the whole time period into account. It's just a truer picture of performance.
Okay, so that's the upside. We know how to measure the potential reward, but you can't have one without the other. Now we have to flip the coin and look at the downside, understanding risk. So in investing, what exactly can go wrong? Well, that's what risk is all about. It's the uncertainty. It's the simple fact that your returns aren't guaranteed. And in a worst-case scenario, it's the chance you could lose some or even all of the money you started with.
Now, not all risk is the same. Some risks are what we call systematic. These are the big ones, the ones you can't control. Think of things like inflation eating away at the value of your money, or the entire stock market taking a nosedive. You can't just diversify your way out of these problems. They affect pretty much everything. But then there are the risks you can do something about. We call these unsystematic. These are specific to one company or one asset. Maybe the company you invested in just isn't doing well, or a bond issuer can't make its payments. The good news? This is where diversification really shines. You can absolutely reduce these kinds of risks. All right, so we've got the upside, return, and the downside, risk. Now for the really interesting part, the great balancing act. How do we actually measure these two things and see how they connect in the real world? One of the key tools we use for this is called beta. Don't let the name scare you, it's pretty simple. Beta is just a number that tells you how much a stock tends to move up and down compared to the overall market. It's basically a measure of that big picture, systematic risk we were just talking about. Here's the easiest way to think about it. The market as a whole has a beta of exactly 1. So if you see a tech stock with a beta of 1.4, that means it's more volatile. It's going to swing more wildly than the market. On the flip side, a stable utility stock with a beta of 0.6 is going to be less volatile. It's a smoother ride. And you know what? This kind of thinking is at the heart of what the pros do every single day. Look at this quote from Warren Buffett. It's so simple, but so powerful. He's basically saying you always have to be comparing your options. Is the potential reward from stocks worth the extra risk compared to, say, safer bonds? It's a constant question. And that really brings us to the classic showdown, stocks versus bonds. You can see it laid out here pretty clearly. With bonds, you're generally looking at lower, more predictable returns. The big risk is that the issuer just can't pay you back. With equities or stocks, the potential for high returns is there, but you have to live with the ups and downs of market volatility. It's the perfect example of that risk-return trade-off. Okay, we've talked about math, we've talked about markets, but there is one more piece to this puzzle. And honestly, it might be the most important piece of all. It's you. It's your brain on money. Because your own psychology can be your biggest advantage or your own worst enemy. The father of value investing, Benjamin Graham, he nailed it. He said markets are more psychological than logical. And he's right. So often, it's our own emotions, our own built-in biases that get in the way of making smart, clear-headed decisions. Let's start with a big one, loss aversion. This is baked right into our DNA. Studies show that the pain of losing, say, $100 is twice as powerful as the joy of gaining $100. It just hurts more. And that's why it's so incredibly hard to sell a stock that's gone down. We'll hang on just to avoid that feeling of locking in the loss.
And then there's the herd mentality. Oh boy. This is that powerful pull to just do what everyone else is doing. It's the FOMO, the fear of missing out, that makes people pile into a hot stock at the very top. And it's the sheer panic that makes them sell at the very bottom, right when the crowd is running for the exits.
This quote from John Maynard Keynes just sums it up perfectly. It's kind of a weird thought, but it often feels safer to fail with everybody else than it does to succeed all by yourself. It feels less lonely to be wrong in a crowd, and that's why going against the herd takes so much guts.
So what's the solution to all this? It really comes down to having a plan, a disciplined framework. When you hear Warren Buffett's famous rules, rule number 1, never lose money. Rule number 2, never forget rule number 1. It's not just about the dollars and cents. It's about having the discipline to not let your emotions and biases take over the driver's seat. And that's really what I want to leave you with. Look, understanding the numbers, the betas, the CAGRs, that's all step 1. It's important. But the real game changer is understanding yourself, knowing your own biases, your own emotional triggers. That's what really makes a difference. So the question isn't just about Buffett's rules, it's about yours. Knowing all this, what's going to be your rule number 1?